Awesome, guys. Well, welcome everyone. Just want to welcome you to our monthly Bronson Equity Investor series. We do this once a month to provide value and education. We have just an amazing panel lined up for today. Masters of real estate. We've got some amazing women in real estate. I'm really excited to feature a bunch of amazing women that are doing huge things, kicking butt and taking names. So really excited for that. So we're going to get in and we're going to give a quick intro. We're going to jump in and then we're going to have some Q&A at the end. But one of the coolest things right now is I think that right now in real estate, it's an incredible time to be in real estate because there's been some pain, particularly in larger deals and multifamily and other areas. And if you are paying attention, the best time to be greedy is when other people are fearful. And so we're seeing some fear in the market. And so we're going to get into kind of some struggles, some opportunities, things that are there. So we'll go ahead and jump in. Welcome our panelists up. I'll give them a quick intro, and then we're just going to jump right into it. Again, if you have a question, you can drop it in the Q&A or the chat. We will address questions at the end. So maybe hold your questions, and then we will go from there. Now, I've got three Kathy Fettkes here, so I'm going to start welcoming people up as the as hosts here. So I'm just going to kind of welcome everybody up here. So, all right, let's see if I can get everybody up. Here's Veena. Okay, awesome. And then I need to find Kaaren. Is Kaaren here? There's Kaaren. What to panelists? Yes. Okay, you've been promoted. Kaaren, where are you? There you are. No. Okay. It looks like, okay. Can you guys say something? Kathy, Veena, Ashley, you guys am I hearing volume there? Okay, awesome.
Yeah.
Everybody's here.
We're
Okay,
all
great. Just want to make
here.
sure we got
Woo.
everybody here. We got some amazing ladies. Awesome. Well, put in the chat too who you're here to see, how you kind of found this educational event, or if you're watching this on a replay, I'd love to see that. Just go and drop that in the chat there. We give a quick intro. We'll go ahead and get started. If we haven't met yet, my name is Bronson Hill. I'm the CEO of Bronson Equity. We have about 250 million in real estate, mostly multifamily assets. We also buy businesses, things that cash flow or provide tax benefits as well. So let's do a quick introduction. We have Kathy Fettke here from the Real Wealth Network. I was just interviewed on her show earlier today. So great to see you again, Kathy. Welcome.
Good to see you. Is this the brunettes against the blondes? Just wondering, is this like a just want to know.
Yes,
Oh,
yes.
you're
Well,
both. Okay.
both. Okay. She's a tiebreaker then. It's more blonde than, yeah. Um, awesome. Yes, it may be. And I don't know where I would fall in that. I guess I'm normally more brunette, but I'll be blonde, bald guy today. We've got Veena Jetti from Vive Funds. Welcome, Veena. How you doing?
I'm good. Thank you for having me. I'm excited for this discussion today.
Excited you're here and you're coming from Chicago where you have an awesome event tomorrow. So excited that you're doing that. So thanks for making time for this.
You.
And then we have Kaaren Hall with UDirect IRA. Welcome, Kaaren. How are you doing?
Oh, good to see you again, Bronson. Yeah, doing
Awesome.
great. Thank you.
Glad you found your way in here. And Ashley Bardown Investments, welcome.
Thank you so much for having me.
Oh, it's so good. I'm excited. I love that background there too. It just gives me amps me up. It's like a visual coffee there. So it's really great. So I love it. So guys, let's jump in. Obviously this is every real estate market is unique. This one is very interesting. There's a lot of people that we've noticed have some fear in the markets. And I wanted you to start with this one, Kathy. Just talk a little bit about rising interest rates the last couple years, and even where we're at, maybe some signal that the Fed may be lowering rates later this week. And so can you just talk a little about what's happened to real estate investing in the last couple of years, how it's affected you, and kind of what the outlook is going forward here?
Absolutely. I mean, we all know that the Fed has been on a mission to slow down the economy, to bring inflation back down, and they have pretty much achieved that. It's getting closer to the 2% target they've had. So now their focus is the soft landing. The job market is going to be what we need to pay attention to, and we are seeing job growth slow down. In fact, the number of job openings are close to pre-pandemic levels. So the question is, will the lack of job growth continue? One of the metrics that we're paying attention to right now is jobless claims, because that's still really low. So even though there's not a lot of new jobs, there aren't necessarily job losses to any kind of recessionary level. But the bottom line is the Fed is ready to pivot. That's pretty clear, and that could happen tomorrow or sometime, this week, where the Fed will likely reduce the overnight lending rate by 0.25%, by 0.5%. Some people are saying, I think like 7.75. We don't know, but we're definitely experiencing a Fed pivot. But historically, that would mean stimulus to the economy. And historically, that would tend to mean that asset values are going to go up. But we're in such a weird market post-pandemic. It's really hard to predict anything at this point. So it's just really important still to be cautious.
Yeah, no, absolutely. Being cautious is definitely important. I believe I looked this up earlier. The Fed Reserve meeting is Thursday and Friday. So on Friday the 20th, we should have, I think, 2 p.m. Eastern, an announcement as far as what's happening. So that'll be interesting to see. A lot of us have, felt like, hey, they've been, at least you're a real estate investor, and especially in multifamily or some other, assets, there's been some challenges there. Veena, why don't you talk to us a little bit about how you're navigating the current interest rate environment, and are you acquiring new deals, or what have you how's it looked the last couple of years, and how are you seeing the forecast right now?
Yeah, to your earlier point, I'm in the large multifamily space, and it has been really painful for deals that we have adjustable rate debt on, which thankfully is not very many of them, but the ones we do have adjusted all the way up pretty quickly. And I don't know how an operator is surviving if they don't have a rate cap on their deals right now. I mean, it is terrifying to think that you might have like $50 million in debt that is just floating with no rate cap. So we're definitely seeing some pain there with operators who are in that position. Thankfully, we have rate caps on all of our deals. So it is painful. We have paused distributions on adjustable rate deals right now just because all of our cash flow is being eaten up by the debt. However, we are still acquiring. So I'm actually mid deal right now. Last year we actually closed, is actually appropriate for this panel. We closed on the largest all woman led multifamily transaction in the country last year.
Yeah.
Very exciting, but it was a really great deal because we assumed debt at 2.77% fixed for 12 years. So
Whoa.
right. So when you're doing deals like that, those still make sense all day long. So right now we're under contract on a deal. It's a Dallas deal, actually. And I haven't bought in Dallas in 6 years. Nothing is penciled in 6 years in Dallas. And this is probably more of like a core plus asset, is what I would call it. It's like in the Addison submarket. And this deal, we're assuming debt on this as well at 2.59%. So again, the debt is really accretive to returns for investors, but without that, I'm not sure that we could have bought these deals. It probably wouldn't have made a whole lot of sense right now. So it is hard to find deals that are like market rate deals. A couple of the interesting things that I'm seeing now for large operators is a shift toward like seller finance or creative finance on deals, which absolutely will make sense because now your interest rate issue goes away. Or at least it changes, right? And then the second, and this is something newer that we've just started looking at, like, and when I say newer, I mean in the last like 2 weeks, I've started diving into it. So this is going to be maybe secret sauce, I don't know. But there is a program in Texas, and they have variations of this in different states, called like HFC programs, and it's basically a affordable housing program that you can utilize on multifamily assets. And for someone like me who's like resistant to that word because we buy value add and core plus at market rate deals, one thing that I have found in just last 2 weeks of looking at it is, with nationwide rents softening as much as they have, our deals are pretty much close to 80% of AMI anyway. So there is a way to leverage that. And basically what it does is it'll wipe out your entire tax burden on the deal. So you go from paying, call it $1 million a year in tax, above the line, and you can wipe that out by leveraging these different programs and then putting, fresh Fannie, Freddie, or CMBS debt on it, and leveraging like the tax efficiency of these programs to create affordable housing. And so I think affordable housing is probably going to be kind of a big play in the nearish future, just because there's such a shortage of housing. People can't afford to buy with where interest rates are. Inflation is insane. Nationwide rents have been softening anyway. So it feels like this is probably a time that a lot of people will start looking at that or pivoting there.
Yeah, it's a really great point. I mean, you brought up Texas. We've done some stuff in Texas over the years, and there are some really unique tax benefits in certain areas, or even almost like Texas development zones, or just things for specific properties. It's really unique as far as tax abatement and stuff. And then we've actually bought a couple of properties recently in Dallas area, over 30% discounted from where they were 3 or 4 years ago. And it's like, or at least 2 or 3 years ago. And it's like, I don't know anything else. Like groceries are 50% more expensive. I don't know anything else that's like cheaper except for like multifamily right now. So it's like, to me, me,
Yeah.
it feels like there's like a little bit of an inflection point there where there could be
Yeah.
some opportunity. So sentiment has changed, and
Yeah.
so it's interesting to watch. Ashley, talk to us about. I know you're doing a lot in large scale multifamily as well, value add. I'm curious, what are you seeing as far as? I mean, you could talk about anything that we're talking about, the interest rates and whatever, but also I'd love for you to touch base on the rising, construction costs, renovation costs, particularly with value add. Kind of how is that being impacted? Are you seeing that still rise? Have some of the some of the costs come down a bit to do this? I'd love to just learn a little bit more about your value add projects.
I think we are seeing across the board a bit of softening of the construction pricing. Obviously, we saw a huge rise up in pricing with respect to labor shortages and supply chain issues, but post-COVID, I feel like those issues have stabilized and we're getting into alternative means in which to complete construction. So that's everything from new development with respect to 3D printing of housing to container homes and multifamily dwellings by using container shells. So I think there's a bit of a um, let me step back for a second. I believe COVID was just an accelerator event. It was an accelerator on multiple fronts. And one thing, when I've looked at the multifamily industry as a whole, we lacked technology throughout every single aspect of multifamily and specifically within construction. So when you're looking at the opportunity that came out of COVID, it's really the integration of technology to help solve a lot of issues that we were having from value add to new development. I think when you look at the gap that we have across the average rent, which is in the 1500s per door versus mortgage rates where we're, 2,500 average in mortgage rates, we're still seeing a huge gap in terms of affordability. So the demand is there. I've said from day one that we would never have an oversupply of housing because the way in which everyone was talking about all these units coming online was based off of permits, and permits aren't an indicator of work actually being conducted. So when you look at the technological advances that are happening with new construction, but you have the constraints of the interest rate environment, and then you have this gap in terms of affordability, you get kind of into this perfect storm, which speaks to a lot of the points that were already mentioned with respect to where are we going from today. So I think that there's still a lot of opportunity that is on the table for us all to kind of tap into and realize the 30% discounts on pricing, all the way to just with the softening of interest rates. I mean, right now, even whether or not the Fed does 50 basis points or a 25 basis point reduction, it really doesn't matter because it's ultimately priced in on the 10-year treasury anyway. This is only affecting the interest rate environment with respect to residential mortgages. But when we look at rate caps and we look at the interest rates for commercial real estate, we're already kind of settled there in terms of what it looks like moving forward for acquisitions. So I think, it's interesting to see whether or not we see the 50 basis points cut or if we see two more reductions from now to the end of the year, whether they're going to pace it out, because I don't know if, to me, I can see it either way. Kathy mentioned, coming in with a soft landing, but I think if they come in at a 50 basis points reduction, that's almost admitting that they waited too long. So are they going to own up to the fact that they waited too long to do a reduction?
Right. Yeah. And
And
that, oh, go
yeah,
ahead. Sorry. I don't mean to cut you off.
no, I was just going to say one final point is everyone keeps talking about all these jobs that were created, but when you actually looked at the breakdown of jobs, the jobs that were created in comparison to last year, they were part-time jobs. They weren't full-time jobs. So it's not a good comparison to say that there was all these jobs that were created because they were part-time jobs. And if you look at it, most people need to have, depending on the income level, maybe a full-time job and a part-time job to be able to afford that rise in grocery expense or, you know, the new rents that everyone is having to pay.
Yeah, or that new iPhone everybody wants to buy, right? So I think it's, but it's interesting. It reminds me a little bit. You're talking about data and just the importance of data to look at future trends. There's a college class I had in statistics, and the book we read, the textbook, was How to Lie with Statistics, right? So it's kind of like our political system. Just take some statistic and like make it sound really good, right? It's like, well, it's actually part-time. It's not full-time. So there's a lot of nuance to all this, which is great. So I really appreciate you sharing that.
It's like that saying that liars can figure and figures can lie. So
It's like a
that's,
T-shirt. That's like put that on a T-shirt or
yeah.
something,
There you
or
go.
it belongs in politics. Kaaren, I didn't want to forget about you. I really appreciate you being here. You are an expert in self-directed IRAs, other sorts of retirement accounts, and you have some amazing things to share about the economy. We'd love to hear you contribute whatever you wanted to share, add to what's been shared, interest rates, real estate, inflation, anything that you would like to touch on.
Well, I consider the other three women on the panel to be more of the experts on the economy. But I will say what I see in my space, in the self-directed space, with the rates going up like they did, of course, I guess you call that a black swan because I don't think we really saw it coming. And what it did in the self-directed space is create a lot of capital calls. And so that means a lot of self-directed IRA investors needed to have cushions in their accounts to cover these capital calls or otherwise, dilute their interest. So that's something we've seen a lot of. I think that with the rates easing, I'm really hoping that everybody can get better financing, but it's got to be so much higher still than, the 2.75 that Veena is getting right now, right? I mean, it's still going to be higher. It'll be better, but not back to where it was. So we may still see those. But it also, too, in the self-directed space, syndications and, of course, multifamily is the number 1 asset class for self-directed investing. So it affects us all in different ways.
Right. And I think that's, multifamily is the number 1 institutional real estate class. I think the least owned by institutions is mobile home parks, just because of the complexity and the mom and pop nature of it. So let's talk a little bit more. I think we're going to have a lot to talk about, but I want to get into specific takeaways for investors. Obviously, we're not giving any specific advice to any specific person, just a little disclaimer. But what are some opportunities that you're seeing? It could be in the asset that you work in. It could be in other types of things that you're doing personally. I find just talking to really smart people and say, hey, what are you doing personally? And what are you doing in your business? And what's changed and that kind of thing. So Kathy, do you want to start about maybe some opportunities that you're seeing either in your business or you're investing in personally outside of your business? Looks like you're on mute there.
Oh,
Oh,
rookie
there we
move.
go.
Rookie move. All right. So you asked that in the last question, and I didn't really answer it, but I tend to be a contrarian. So right in 2022, when the Fed was raising rates and the housing market just froze, people were just thinking that there was going to be a housing crash. But we really study the basics of it, and there was far more demand than supply, yet this lack of affordability. So I immediately started a single family rental fund, and we raised about $8 million to go buy as many little kind of rundown houses that we could find in North Dallas by Sherman, where the chip manufacturing is coming in there. There's billions and billions of dollars pouring in, infrastructure growth, freeway expansion, airport expansion, and yet the housing market was frozen. So we had wholesalers who wouldn't have talked to us a year before. There would have been 90 people making offers and way, way too high of offers that would have not made sense to us. Suddenly, these wholesalers were coming to us and cutting their prices in half to the point where we were buying houses for $50,000 to $100,000 that needed about $25,000 to $50,000 in renovation. So these are homes that a homeowner couldn't buy because they were not in a condition that a bank would lend on it. So taking older homes, making them affordable housing for these new tech workers coming to the area, and no competition. So that was an exciting time. And we weren't dependent on rates. I didn't care about rates because we raised enough money that we could just go buy, renovate on the money we raised, and then refi later with loans that made more sense. So that's one way we kind of went through a time that was a little scary to do anything. Now we're kind of finding the same opportunity where a lot of builders got wiped out or challenged, just like they did in 2008. when rates went up, that didn't just affect multifamily and people on adjustable rate mortgages. That's construction loans, and construction costs have skyrocketed. So right now you do have another opportunity to kind of, I don't want to say be sharky, but you can find these deals. But in many of these deals now, and also what we did in 2008 was bring the developer along who's about to lose everything. They know the project. I think I think Ashley's doing something like this too, where it's kind of like a pref equity fund. But in this case, the way we structured a deal we found in Oregon was the guy just was way over his skis. He'd put in all the infrastructure, finished out the lots, put in the roads, the sewers, the electrical, all this stuff that costs so much money and is so much risk and development. And we're able to get an option on all of those lots for about half of what they cost. We don't have to raise the money to acquire the land or do the development. We just have an option. Only had to put up $1 million for that instead of 10 million to buy the land. And we can build to demand, build to suit. And we don't have to pay for the land until we sell to a final end buyer. So again, not taking on bank debt. I don't care about the cost of money right now because we're not using it. We are just, doing the option, building the houses and selling them and keeping the price affordable for those buyers.
I love it. You mentioned contrarian investing. And I think that as an investor, I just think it's so good to have different things that you look into, right? If you only do multifamily, you only do single family, you only do, private equity, you only do certain things, it's like that. It could be a great time to do it as a great opportunity or not. And so being able to look into other things, sometimes when certain things are going great, somewhere else there's an incredible opportunity, but it involves, making unpopular decisions where not, if a company you're invested in is now on the cover of Forbes, maybe it's time to consider selling, right? It's like the idea of like just being aware of like things that are in and out of favor. Veena, what are some of the same question to you? What's something you're doing in your business, out of your business, opportunities you're seeing right now?
Yeah, so we're pretty vanilla in our investments at Vive. Our investors know, like, and trust us for the one thing that we try to do exceptionally well. So we don't really deviate from that a whole lot on the Vive side. Personally, our trust, I like to say we're very diverse. My attorneys and tax people do not agree because it's like we're diverse, but 90% real estate. So they're like, that's not diversity. We need to be out of real estate too. But I'm like, no, we're in different types of real estate. So, we're invested into assisted living facilities. I am in like production studios that are in like the middle of nowhere, Georgia. I'm in restaurant, I'm in retail. I'm in industrial, I'm in the Airbnb space, which is not doing well. But I think maybe one of the more interesting purchases we bought hotels recently, but probably one of the more interesting spaces that we just got into like 3 weeks ago, actually, we bought a bank in Northern California. So it's a federally chartered bank. It's called Monterey County Bank. And there's like a small group of us that got together, bought it, and it is the #1 SBA lender in Monterey, California. So it's in a really niche market there, but the strategy around it is really like a roll-up strategy to come in and roll up other bank and other distressed assets into it. So it's definitely like a little bit riskier as banks go, but what's interesting about it is we are currently in process of getting the MDI, the diversity and minority and diversity tag. And once that happens, basically they have come to us and said that they will split the risk of the insurance. The FDIC has come to us and said they'll split the risk of bad deposits or deposits that tank or non-performing assets. And we already were able to clean a lot of that off the balance sheet before we even bought the asset. So it's like a very interesting structure. I wish I was the brainchild behind it. I'm not. My mentor was the one who put the deal together. And so we've gone into that, and that's definitely a newer asset class for us. But I definitely think that it is probably something that will do well. Similar to Kathy, like we are opportunistic buyers in our own portfolio. So we bought last year, we bought some Airbnb rentals that and when I say they're not doing well, they're not doing well like what they were doing 5 years ago. They're still cash flowing and they're producing income, but it's also the headache of when you own multifamily, it's really hard to own single family assets because they just don't scale the same way.
Yeah.
And they just don't produce cash flow in the same way. And when there's a problem, it's the same amount of mental and time sacrifice to solve that problem. And it just doesn't generate the same kind of return as multifamily. So it's very tough to own single family. We still do own single family, but I would say all in all, we are taking some more risk, but we're hedging it pretty significantly with more conservative investment opportunities.
I think that's good too to have. I mean, obviously everybody's different. That's when I was an investment advisor years ago. It was like, how do you determine what's suitable for one person or another? Some people have a much higher risk tolerance because of their situation or just their personality. Some people, want to have things set up a certain way. So it's nice if you have a certain net worth, you can take some shots on bigger things that have a little more risk. I think that's good. Thank you. Ashley, give us your thoughts. What opportunities are you seeing in your business? What are you doing personally? I'd love to ask you.
Within the business, I think there's a great opportunity to tighten up operations. And I think that, I mean, I'm a huge proponent for operations. I was a huge proponent for operations when the interest rate environment was really frothy and everyone was jumping on selling these properties for huge margins without truly operating them. And I think that, a lot of people are now learning the lesson of what happens when you fail to learn how to operate because you can't operate through all market cycles. Across our portfolio, we have average occupancy across the portfolio over 93%, and our collection rate is over 99% across our portfolio. So to me, like, we're now getting to the level of operations that is just like, I mean, I think it should be fail proof. We're putting together systems in place. The granularity in which that we are dissecting something, like, I'll give you a case in point. When someone comes on leasing, I know exactly where percentage wise someone's going to stop in an online leasing application. I know from a heat map on our site, like, that's the level. I also know the level of renovation I'm going to do on a per unit basis to base off of my ROI. Like, these are the level of details we take our business plan to. And I think that within the business, just as an industry, a lot of people weren't doing that. So then when times get tough, it's so overwhelming. So that's something internally that we've always been focused on, always been a huge proponent on, not waiting for the market to dictate how we operate, but we operate really, really strongly regardless of where the market's at. Outside of multifamily, we have a lot of different investments, just like the other women, and I'm sure Kaaren, you're going to have as well. But we are invested in everything from tech to a rum company to we just launched a website marketplace in February. I mean, we're in all different asset classes, but that is really kind of separate of the multifamily. And we're huge believers, just like, we were talking about earlier about really partnering with strong operators, because we come from an operation background. We know that operations is the most important thing in a market, like the most important thing regardless of the market cycle, but in a down market, it is the most important is the operator. Pretty much every other piece of the puzzle can be replaced, but you can't replace the operator. So someone who has the ability to come up with the systems, the vision, that's really important for us. And that's where we see opportunities. So when we look at an industry where we know that we have a strong operator that we can consult with, and we feel that that business is not running efficiently, that's typically where we'll kind of infiltrate. So there's a few businesses we're looking at acquiring right now that are in that position.
That's great. I love the diversity and also what you're doing in your business, lots of data and lots of detail. So thank you for sharing that. Kaaren, I know you have a unique insight because you're, I mean, like, was it 2 billion of assets coming in, doing all kinds of different creative. I was asked you one time, like, what's the craziest thing you've seen? So maybe you've seen all kinds of syndications and all kinds of investments, but what are some, I mean, you mentioned capital calls, but what are some things that you're seeing as opportunities and what are you doing personally?
Right. Well, what I'm seeing, and I'm just so happy to hear from the other panelists that they're just so confident and they have such really great assets that they're working on because, our account holders are looking for something outside of Wall Street. I don't have to tell you how volatile Wall Street is. It's up one day and down the next. And got obviously this, oh, did you know there was an election coming up in 2 months? So that doesn't make people feel very confident. So there's a lot of money leaving the market into self-directed accounts. So we've seen a few, record months lately of people leaving the market and looking for the very deals that you women are discussing. So it really gives me a lot of confidence for the investors that there's solid deals out there, really things with a lot of substance. So that's what I see. I see a lot of market volatility. I see a huge increase in the number of people leaving the market, heading into alternative assets. And of course, we're talking about syndications, but also sometimes it's note investments, maybe a trust deed or something like that. But we're also, Veena, you're talking about a bank, and the other thing that's maybe on the horizon, we hear the distant thunder of central bank digital currency or crypto, this sort of thing. So crypto is another asset class that people can invest in with their self-directed IRA. So I'm glad it ties to one of the assets that we're talking about. So crypto is also picking up in interest. So I think people like to hedge, their investments in a time of uncertainty and do a little bit of everything, including precious metals and all this. So we're seeing an uptick in these and not real estate assets as well as a solid real estate assets. And where normally 90% of the assets that people are investing in with us are correlated to the real estate market. And it's still that way, but it's trending off more to the alternatives, like, again, crypto.
Yeah. Yeah, that's great. No, the alternatives, it's great. We've shifted the last couple of years. We've shifted from being a primarily real estate group to doing a lot of alternatives, businesses, car washes, ATMs, oil and gas. We've got an oil and gas deal coming up for some of the tax benefits tax play that comes out of that. And then I was telling the ladies earlier, we have a business we're looking at buying. I mean, it's some of these businesses, it's just insane, the cash flow. It's like, what would be like a 6 cap for a multifamily deal. It's like a 30 or 35 cap when you look at some of these businesses. Obviously, there are different risks. You have to understand the business. You've got to have the correct partners, but that's some stuff that we're doing in the business. And also owning some precious metals. I like precious metals as opposed to owning cash. So not as an investment, but as a store of value. And then you actually, if you have them in a vault, a third-party vault, you can actually borrow against the value of it, like a HELOC, and access your equity if you need it, which is really interesting.
Yeah,
so,
when they're personally owned, I have to add. We
yeah,
have the whole thing about the no gold at home. So I just want to make
no
make
gold
that
at
point
home.
clear. Yeah, the
That's right.
IRS got real clear about that.
They don't like that. Yeah. So
No,
there's,
not so much.
so if you have specific questions about anything related to retirement, Kaaren is amazing. Our team is awesome. So I encourage you to reach out, just super helpful. And she just provides all kinds of great resources. Well, I got to be honest, ladies, part of the reason I brought you all here is my daughter is 11 years old and she's amazing. She's smart. She loves to read. She's just started middle school, plays soccer. And when I go to real estate events, I go to a lot of real estate conferences, I see it's like 5% women, or it's just not a lot of women there. And so I wanted to say, both as a fellow investor and just each of you, I just have tremendous respect for each of you and what you're doing in the field. And obviously there's been a journey there, but I'd love to see, first of all, what is it we can do to encourage more women to be involved in real estate, or even just what's the reason we don't see more women, or what are some things that have helped you to be successful? So I'd love to talk about that. Let's start with Kathy on that one.
I think there's a lot of women in real estate. They're everywhere and they're very, very active. And we're starting to see more, more of them. For some reason, not so much on stage. And I'm not sure why that is. I've been wanting to start a mastermind or some kind of training to help women feel more comfortable to show how much they know and to be willing to teach. I've been really blown away by the number of really active real estate women that I've seen out there just doing baller stuff, really amazing. So I don't know. It's just, I don't know. I'll tell you, if any women listening, when I see a panel that's all male, I will literally call the person putting on the event and say, you need, come on, dude, like, come on. And that's how I end up on stage,
Yeah.
because it's just not right. So, you just got to ask for it, and if you see that I still, again, am one of the only women on certain panels, and I love this one, but I'll just be pushy and ask for it. So it's worked.
Love it. Love it. I think that's great. Veena, what would you like to add?
Yeah, I have like a big axe to grind about this one because I do speak on a lot of stages like Kathy. And I think last year I spoke on 110 stages.
Mm,
I spoke everywhere.
wow.
And I cannot tell you the number of times I am the only woman on a stage, or I just spoke at Clever Summit. There were like 27 speakers, 4 women, and I was one of those women. And there was only one other real estate woman speaking. And look, Cody is a good friend of mine, so this is not a knock on him personally, but it is, I did call him up immediately and go, "What happened to all the women?" And the response consistently, yeah, because I asked this question too, just like
Yeah.
Kathy, I do not let it go unchecked. And if you ask me to speak on a stage, I'm going to try to show up because I do want to represent women. And I do want women to know that we belong on those stages. But what I always do, every single stage I speak on, I always make it a point to say one other woman's name on that stage. No matter what. You will hear this consistently from me on every stage I've been on every podcast I've been on. I've always made sure that I say another woman's name and shine light on another woman who's doing something incredible, regardless of the space that they're in, because that's how we support each other and that's how we create space for each other. What I would tell the people listening is when you go to these conferences, you are the product. And so it is really nice and it is really kind when you come and you tell me, like, "Oh my gosh, you changed my life and you did an amazing job." And I can't even tell you how much that means to me. Also, tell the organizers that. Tell them that you want to see more women on stage. Use your dollars to vote. I had someone who reached out to me on Instagram just about a month ago and said, like, "Hey, Veena," and we're friendly, we know each other, we're acquaintances. And he goes, "Veena, here's my flyer. It would be a really big help if you would share this to your audience." I look at the flyer, there's not one woman on there. So I'm like, "You have the audacity to try to leverage my audience that I have built and I have poured into and I have added value. And you want to leverage my audience to promote your agenda, and you couldn't put one single woman on your stage." And so they don't call me Petty Jetti for nothing, right? And so it's like, "Oh my gosh, I'm so proud of you. This looks like an amazing event. Unfortunately, it looks like a men's event, and I don't think that'll resonate with my audience." And he goes, "It's not a men's event." I was like, "You could have fooled me because this doesn't look like a safe space for women to be in
Yeah.
or a welcome space for women." So, I say all of this to tell you guys that organizers want women on stages. They recognize that this is a gap in the industry. They recognize that there's a shortage of women. To Kathy's point, a lot of women are uncomfortable speaking up. And rightfully so, because we've never been afforded that opportunity. It's never been represented or modeled to us. But now's the time to change that narrative, right? So everybody has something of value and everybody has a story to share. My good friend Jen Gottlieb talks about being seen. And one of the things that she says ad nauseum is, do not compare your chapter 1 to someone else's chapter 20. And so if you go and you're like, "Oh my gosh, I saw Kathy speak and she was incredible." Yeah, she is. And of course she was incredible speaking. She's also been doing this for 1 million years. So if it's your first time being on stage, you don't have to compare yourself to Kathy or Ashley or to Kaaren or to myself. You can tell your story, and that's also important and also valuable. So know that you belong at this table. And if there's no room, then make your own table. Let's make our own table and let's show up there and let's add value there, because we have perspectives that men just simply don't have. We're the default caregiver, we're the default child, we're the default parent, we're sisters, we're friends, we're mothers. Like, we are so many things and so dynamic and so capable that we should be on those stages. We have valuable insight. We can make that change together. And I want to say too, like, Bronson, I want to give you your flowers here for putting all of us together and for highlighting women and for making sure that this is a topic that we're addressing and talking about. I think that's like the hallmark of an alpha male, is somebody who says, "Wait a second, there are important voices missing from this." And then you're willing to leverage your platform and your audience to make sure that women are heard. So thank you for that. I'm the mother of twin 5-year-old daughters. So this is very important to me too. And I really appreciate you using your platform in that way. Thank you.
Yeah, no, I really appreciate the passion there. And I just want to share to people, even if this is not an issue that resonates with you, it's really important. I think I have some amazing friends that are women that I know that I'm just like, why aren't you doing deals? Why aren't you doing this stuff? And I think there's a gender thing that a guy will have 3 out of 10 qualifications for a job and will apply with no problem. Women will have like 9 or 10 and still be like, I'm not sure if I should do it or not. As investors, I think women actually probably do better as investors because they're more conservative. They approach things and so we need the perspective. So I think, for all of us, we have siblings, we've got children, we've got people, and I think we need to really promote women that have a passion to do this and really spotlight it for them. So I love like ladies like all of you guys that are standing out there, being on stages and speaking and standing up. So I love it. So thank you for sharing that. Ashley, I know this is a passionate topic for you too. Please give your thoughts here.
Okay, you asked for it.
Yes. Okay. Let me buckle
here
up.
I
Okay.
go.
I'm ready. I'm ready.
Well, first of all, I wrote the book, The Only Woman in the Room, with
Yes.
Kathy and 18 other incredible women. And it was all intentional too. That's my dog who's now like trying to sneak in on this. But it was intentional in the sense that I attended a conference. There were 450 people in attendance, and Liz Faircloth and Andressa Gadelli, who are the co-founders of the Real Estate Invest Her community, wanted all of the women in attendance to have lunch together, and just 2 tables pushed together, comprised of 16 women, were enough to seat us all for lunch. So I looked around the room. Now, keep in mind that, first of all, I have always been surrounded by only men. I went to an all men or all boys high school. It went co-ed my sophomore year. It was 3.5 to 1 odds. And then in college, I lived with 14 guys. So, and just myself. So I am used to being the only woman in the room. But for some reason in this situation, it was like a light bulb went off, and I was like, I cannot believe that I am the only woman in the room, kind of, with 15 other women here. So as I was driving home that night with my husband, I said, I'm going to write a book titled The Only Woman in the Room. I don't know what it's going to look like, but I need to like speak on this because I feel like no one's talking about this. Fast forward, in doing my research on this, I found pre-COVID that women outlive men 6 to 8 years on average. And during that period of time, it costs on average between $286,000 and $316,000 for cost of living during those years. So essentially, regardless of whether or not you are a woman, it is a high likelihood that you are going to have a mother, sister, aunt, cousin, daughter, someone that you potentially might have a financial responsibility to help sustain that person during that latter part of their years. With respect to why I think that there are less women than men at events, I think it's twofold. Number one, I think it's because it's a generational thing. If you look back on education of women across different generations, women were encouraged to pursue different types of fields. So when women were finally encouraged to work, they were encouraged to work only in administrative positions. It was only recently that women have been encouraged to go into STEM fields. If you're in real estate investing, you have a pretty strong foundation of some sort of STEM field, mathematics, science, you name it, technology. Those are the fundamentals you need to be a good investor. And ultimately, I think that women will outnumber men in the coming years in real estate. Number one is because I do believe it's a generational thing. If you follow the numbers, it's obvious. It is glaringly obvious. So all these organizations that aren't doubling down on getting women on stages, women's as the head of their organizations, they're missing the boat. But number two is the fact that women are the growing, if you look at it in terms of 2 different groups within the organization, they're growing. Men are actually shrinking in terms of presence within the organization. So women have the ability to lead. And to your point of what you said earlier, Bronson, women actually do on average make better investing decisions than men because they are more analytical and critical in decision making. To what you said earlier, it is not a belief, it's actually proven across different societies, different age ranges, but ultimately it's been proven time and time again. So to me, I think that there's a huge opportunity for women to really take center stage. And to that effect, after writing the book, the whole reason I launched the tech company that I launched in February was to get more women on stage. So I just launched a company called Conference Connect, and it's to connect event organizers and speakers to get more diversity on stage. The only statistic on diversity on stages is that 30% of events do not have a Black male speaker. There are no statistics regarding women on stages. Well, when you go to conferences, why do you go to a conference? Because you want to be around people like you. You want to learn and be educated and network with people that are like you. If you don't see people like you on stage, you are more reluctant to not attend the event, right? You're reluctant to attend the event. So the diversity on stage is going to not only bring more people to the audience, but it's going to bring more opportunities to those folks who are in the audience, so then they can then pursue those different, whether it be real estate investing, technology, any other opportunity that's presented, because we all know that conferences breed so many opportunities, not from a knowledge base, but from networking alone.
Awesome.
So
Thank you.
that's my soapbox.
I know we got a lot, and we've got your book too, The Only Woman in the Room. Highly recommend people check it out. I didn't know this would be such a passionate topic, but I should have known, right? You guys are all passionate in real estate about, women in real estate. We'll get to some questions here in a minute. I do want to get to Kaaren, but if you do have a question, you can start dropping it on the chat. Kaaren, what would you like to add? Why aren't there more women in real estate? What can we do about it?
I don't see it that way. I mean, obviously that's your experience, but I've been so blessed to be in California where there are some just amazing, powerful women like Christina Suter, like Deborah Razzo, like Kathy Fettke, like even Iris Veneration. If you're and so many women, powerful women leaders in the Southern and Northern California markets. When I'm on stage, it's usually with Amanda Hahn or another tax professional, because obviously my topic is related to tax. So I'm not usually the only woman on stage. I'm usually with someone, which is great. My first career, though, way back, I'm older than I look, was radio. I was a radio announcer, and that was all men, and I was definitely the only woman in the room then. So I remember going in San Francisco to a conference, and there was a special breakout session just for the women broadcasters. It just seemed so condescending. Like, we're broadcasters. We're not men or women. We're broadcasters. Let's just be in one room. We don't have to be set. We're already separated. You don't have to separate us even further by calling attention to it. So I think that, I have a daughter. I think you're all saying you have daughters. And, my daughter got a degree in pure math from Berkeley, and she's killing it. She's super proud of her. And I taught them actually through Invest Club for Women that was here in Southern California. We did something called Magic of Money. And my daughter went to that and learned so much about money and about saving it and money management. It was really great. So I've had a lot of really good experience with, women leaders in the California market.
I love it. I love it. And I just want to say, I just really appreciate each of you for the value you bring, to my life, to the lives of those around you, those you're impacting. And I love what you're talking about, women on stages. And it's something, it wouldn't really cross my mind. Oh, we need to have more women here, but it's great to hear that. So I really appreciate it. Awesome. A lot of comments about Christina Suter here. She's in the room too. She's making comments here. So if someone wants to chat about her, how great she is, she's here. She was actually my mentor when I started. So I started in a single family. And so I don't know if all the ladies know Christina Suter, she's amazing. But anyway, wanted to take a few questions. So if you have any questions, we can talk about this topic. We can talk about the economy. We can talk about rates. We can talk about any of the things that we've talked about, or even the stuff we have not brought up. Feel free to drop it in the Q&A box or in the chat. We can go through a couple more questions, but I want to make sure that if anybody has any burning questions, we can get those answered. That's really what this is for. And it's amazing when you get amazing people, and today amazing women, talking through topics together and kind of collaborating together. So I guess what we can do is just maybe, I don't know if we have time to go and kind of ask everyone, but let's I'll go through my list here and just find another question or two. But let's talk about a little bit about, the Fed has really been driving a lot of this. And I know a lot of people have experienced a lot of pain in real estate. And, we've had some deals that have struggled. I think Veena, you shared as well. We've had some deals, especially with some of the debt situation, that have struggled. What do you, I guess, I'll just throw this out there and anybody can tackle this that want fixed rate versus bridge debt. If you're using caps and you have good reserves, pros and cons. I know there's pros and cons. Some people would say, oh, I'd never do anything but, fixed rate. And then it's like, oh man, but I paid millions of dollars of prepayment penalties to sell or other things. So there's pluses and minuses. Can somebody touch base just on that topic there? Who would like to take it?
I mean, I'm happy to share my thoughts on this. I have both in my portfolio. To your point, I think what happened in the last like 6 or 7 years was the market was just so kind to not really great investors. And what happened was interest rates were so low, people were buying and selling. Like right before we got here, we were backstage and I was telling you guys about a deal I turned around for a $30 million profit in 18 months. That's unusual, right? Like when I have investors ask me what's the best deal I've done, I tell them about this and I'm like, but please don't use this as a metric because sometimes it's better to be lucky than good. And we were definitely lucky in a lot of
Experience
ways
that.
on that, right? Uh,
Yeah.
so I think to your point, right? Bridge debt is a tool, and when used appropriately, it can be really helpful. But you wouldn't take a hammer to do the job of a wrench, right? And vice versa. And so when you're leveraging adjustable rate debt, what happened a lot is new sponsors would come into the market and they either couldn't qualify for Fannie or Freddie debt, or they couldn't make the deal work because they were overpaying for it so significantly that they had to use low interest rate debt and like a bridge debt or a product like that, thinking that the market was going to continue carrying them and then they were going to be able to turn it around and sell it at this massive profit a few months later. And that did happen a lot, but also the people that bought at like the end of 2021, early 2022, when the market hadn't started moving yet. And we were talking about this backstage, right? Like there are a lot of operators that don't have rate caps on their interest rates. Like that is a huge problem. We all heard about the Apple's Way portfolio in Houston. There was no rate cap on it. So they went in at a 3% leverage or a debt and they ended up with it at like 8% after 8 months, 10 months. Now I'm not part of that deal, so I don't know the inner workings of it. But generally speaking, if you're buying thinking your underwriting is going to stay at 3% and then all of a sudden it adjusts within a year to 8% and almost tripling, that's going to be an issue for your assets. So I think right now, if you are buying assets, you do need to weigh the risks and the pros and cons to your point. If you're going to sell it, like maybe it's a distressed asset and it has a heavy value add component, you're going to go in, you're going to reposition, and then you want to exit it in 18 months, 24 months, 36 months, then maybe it does make sense to put adjustable rate debt on it. For me right now, it is too risky. We're, relatively conservative investors in what we target. I would rather not do a deal than be aggressive and do just any deal. And so for us, we're like relatively conservative. We're not looking at anything with adjustable rate debt right now. That's not to say we wouldn't, or there wouldn't be a use case for it. But again, it's a tool. And if you don't know how to properly use or leverage that tool, then it's a problem. And that the same is true for fixed rate debt. It's just your risk is lower because you are not at the mercy of what's happening in the market and the volatility of the Fed and the market.
Right. Thank you. Thank you for sharing. I think what we're going to do, I know we could spend a lot more time on this topic, and I so appreciate the background and thoughts, and I have similar thoughts in some ways as well. Let's go around and just make sure we give everybody a chance. If you have a giveaway, if you have somewhere you want to lead people, that people want to follow what you're doing, and we got a lot of people that really enjoyed the session, whether you're watching live or on the replay. So let's start again with Kathy, and just maybe how can people follow what you're doing, follow your shows, or get any freebies that you have? And you are muted there. And you got your new book there. Love it.
Oh, yeah, that's because I was coughing. All right. Scaling Smart is a book we just came out with Bigger Pockets. If you go buy it there, you'll get 3 like bonus material that will help you scale your business, answering a lot of these questions, like how do you not grow your expenses faster than your income? And then realwealth.com is our company with over 500 free webinars, free membership, and we help investors build their 1 to 4 unit portfolios nationwide.
Awesome. Thanks, Kathy. Kaaren, how can people get in touch with you or follow what you're doing there?
Well, they can hit me up by email, khall@udirectira.com, because no one can spell Kaaren. Yeah, And we have a free report. I put a link in there. So if you'd like to find out more, but our website is full of great information. I'm also in the process of writing a book for Bigger Pockets. It's in final edit right now. So that'll be coming out pretty soon. And I'll be at BPCon in a couple weeks, I guess, couple weeks. So
Yeah.
yeah, but in SoCal, but also available nationwide.
That's great. How many you got? I know, Kathy, you're going to be BPCon. Are you guys going to be there as well? Veena, Ashley?
I'm not, I'm scheduled somewhere else.
Okay. Well, when you're speaking 110 times in a year, that's
Yeah.
a lot of, that's quite the
Yeah.
circuit there. So
That's a
congrats on
lot.
that. That's
A
great.
lot.
Ashley, what about you? How can people get in touch and follow what you're doing with what you're doing there?
For anyone who's a passive investor, you can follow us at bardowninvestments.com, and we have some free content and freebies on there. And then anyone who wants to actively invest and own your own apartments, you can follow at apartmentaddicts.com.
Love it. Okay, great. Awesome. Veena, how can people track you and follow all the places in the world that you're traveling and speaking?
So I have free content. I do a lot of free education on my Instagram, but also if you go to veenajetti.com under education, I have a free masterclass there. But I also have a monthly vault, Veena's vault. I put the link here, and if you use the code HILL25, it'll give you 25% off of the monthly. And it's, I don't know what it is. It's like $150 or something. It's not like millions of dollars or anything like that. But I just talk about different topics in the multifamily space, branding, speaking, like all of the generic business topics down to multifamily capital raising, etc. But yeah, you can find me on Instagram. I respond to my own messages there. So if you send me a DM there, you'll be talking to me.
Awesome. And you have a lot of good stuff going on social media. If you want to just grow your social media, watch what Veena's doing, and you'll find ways to
Right.
grow it. So I really appreciate it. Appreciate you being here. Veena, I appreciate all the ladies for being here. I'm going to put in I have a free report, which is this, how to use inflation to your advantage. So if you haven't downloaded this is some outside the box ways to basically grow your wealth through real estate, through debt, through precious metals, through borrowing. And it's kind of something you really won't find somewhere else. That's a free giveaway. I wanted to say really, truly from my heart, thank you for everybody for being here or watching this on a replay. Lots of respect for each of you here as panelists, Kathy, Ashley, Veena, and Kaaren. So grateful for each of you. Would love to continue to host events and do more events with you. It's got me thinking where when I have panels, I need to do, an all women's panel, maybe do like a women on every panel or to have that more often. So anyway, thank you for bringing that to my attention. I think I got a takeaway there. And then also just the real valuable insights as far as opportunities today, what you're doing personally. I find it really, really valuable. So thank you everybody for being here. Again, we will send the replay out with this. And if somebody asked, can we have another session with these amazing ladies? It's absolutely, if they can do it, if we can schedule it, we'd love to do it. So just want to say thank you everybody for being here. We will have an event next month, probably mid next month. We're working on getting Ken McElroy. We've had him at a few of our other events. We're trying to get him and some other folks there. So stay tuned for that, and appreciate everybody for being here. We look forward to seeing everybody at the next event. Thank you, everyone.
Thank you.
You.
Thanks,
Bye-bye.
guys. Okay.
Thank you.